How's it going, everyone? I hope that you're all doing well. I want to welcome you to the first lecture in the higher time frame protocol, where in this lecture, we're going to discuss the prerequisites to order flow, which are PD arrays. Now, the reason why I want to cover PD arrays is because this is the foundation to our trading. And so it's important that I lay out the PD arrays that we're going to be utilizing to measure order flow, and the ones that are most important for our trading. And so, without further ado, let's get into today's lecture. Now, what I'm going to do in this lecture is I've moved over to TradingView, and I'm just going to go through the PD arrays that we're going to utilize in our trading protocol one by one, just to make sure that you're all on the same page. We all understand which pattern we're looking for, because again, these PD arrays are just patterns. And so the PD arrays that we're going to focus on are as follows: old highs and lows, so swing highs and swing lows, rejection block, order block, fair value gap, liquidity voids, volume imbalance, breaker block, and mitigation block. Let's first begin with old highs and lows. Well, old highs and lows are very simple. It's a 3-candle pattern where we have candle 1, candle 2, and candle 3. Candle 2 is higher than candle 1 and candle 3. This would be a swing high. If we apply this logic to current price, let's take this swing high here. We can see candle 1 is lower than candle 2, and candle 3 is lower than candle 1, and therefore we would call this a swing high. If we now apply this logic to swing lows, it's the exact same logic. We have candle 1, candle 2, and candle 3. Candle 1 is lower than candle 1 and candle 3. Therefore, we would call this candle low a swing low. And again, if we just apply this logic to the charts, we've got candle 1 here, candle 2 here, candle 3 here. Candle 2 is lower than candle 1 and candle 3, and therefore we call this a swing low. And we're going to make this blue to showcase that this is a discount array. So premium arrays, i.e. bearish PD arrays, are going to be red, and then bullish PD arrays we're going to make blue. So this is swing high, and this is a swing low. Very clear, very simple. Now if we move on to rejection blocks, a rejection block will form at swing highs and swing lows, just like we annotated here. It's a 3-candle pattern. Let's first identify the swing high. So we've got candle 1, candle 2, candle 3. The high of candle 2 is higher than the high of candle 1 and candle 3, so we call this a swing high. Now the rejection block is going to be from the close of the highest up close candle. So candle 1 is green, candle 2 is green, candle 3 is black, meaning it's bearish, and so the rejection block is going to be from the body of the highest green candle. And we can see price retraces into it and then expands away. This is a rejection block, which we're going to denote as rejection block. For the bullish example, exact same logic. We're going to have a swing low. So in this case, we've got candle 1, candle 2, candle 3. The lowest low of candle 2 is lower than candle 1 and candle 3, meaning this would be a swing low. Now the bullish rejection block is going to be the close of the lowest bearish candle. And so we can see we have candle 1, candle 2, candle 3. This candle 2, the close, which is here, is the lowest close of these 2 bearish candles, and therefore we would call this a bullish rejection block. And as we can see, price retraces into it, rejects it, continues higher, and again rejects it and continues higher. So far we've covered highs and lows and rejection blocks. We're now going to cover order blocks. So a bearish order block is simply consecutive bullish candles followed by consecutive bearish candles. So in this case, we've got bearish candle, bullish candle, bearish candle. This up close candle, which is not consecutive in this case, it's just one up close candle, is going to be the bearish order block. And we're going to draw it from the bodies to denote the actual bearish order block itself. Remember, the wick in this case, this wick here, would be a bearish rejection block. And so we're going to call this the bearish order block. So this is our bearish order block. If I just draw in a few more, we've got these consecutive bullish candles. We've got down close candle, bullish candle, bullish candle, down close candle, down close candle. As soon as price trades below the low of the consecutive bullish up close candles, it becomes a bearish order block. So as soon as price trades below this price level here, these consecutive up close candle become bearish order blocks. And as you can see, price should trace into it, forms a high, expands lower, and expands lower. So this would be a bearish order block. And I'll put this below so it doesn't get messy. And so if we zoom into this candle here, we had bearish candle, bullish candle, bearish candle. As soon as price trades below this price level here, which is the open of this up close candle, this price range here becomes a bearish order block. Now, if we apply this to the bullish example, what we see is we have these consecutive down close candles. So we have up close candle, down, down, down. So as soon as price trades above this price level here, which is the open of these consecutive down close candles, this would become, or this price range would become a bullish order block. So I'm just going to call it bullish order block. And so now we've covered swing highs, swing lows, rejection blocks, and order blocks. I'm now going to cover fair value gaps. A fair value gap is a 3-candle pattern. We have candle 1, candle 2, and candle 3. If the lowest low of candle 1 and the highest high of candle 3 do not overlap, we would call that a bearish fair value gap. So in this case, this is candle 1, this is candle 2, this is candle 3. The lowest low of candle 1 and the highest high of candle 3, the gap between that, the difference between that, is the bearish FVG, or what we're going to call fair value gap. Now, bullish example, we've got candle 1, candle 2, and candle 3. The highest high of candle 1 and the lowest low of candle 3, they do not overlap, and therefore there's a gap, and we draw it from the highest high of candle 1 and the lowest low of candle 3, and we call that a bullish fair value gap. So bullish FVG. We're now going to cover liquidity voids. So a liquidity void is a very large fair value gap. So in this case, we've got these consecutive bearish fair value gaps here, from this high here to this low here. So that's the first fair value gap. And the second fair value gap is from here to here. And when we have these consecutive fair value gaps, we can just combine the two and call them consecutive fair value gaps. If we have large candles here, large imbalances, we would call this a liquidity void, meaning there was only sell side delivery within this price range here, and so price needs to now deliver buy sides in order to deliver price efficiently and then continue lower. And so we would call all of this price range a liquidity void. Don't get too caught up on the terminology between fair value gap and liquidity voids, but liquidity void is a fair value gap that is very large. We're going to call this bearish liquidity void. If we now look at a bullish liquidity void, we can see that we've got this very large imbalance here from this low to this high. We would call this a bullish fair value gap, which you could also call a bullish liquidity void. Reason being, we've got this large displacement leg higher. Only buy side was delivered from this candle to this candle, and so price needs to now revisit that liquidity void to then continue higher. The only difference between a fair value gap and a liquidity void is when we have a liquidity void, price will fill the entire range and then continue higher. Whereas a fair value gap, price will just reach any range or any point inside the fair value gap and then continue in the desired direction. Don't worry too much about liquidity voids. Again, I don't necessarily use them. It's the same pattern as a fair value gap. There's just deeper logic as to why they work. So we're now going to cover a volume imbalance. Now, a volume imbalance is just a gap. So there's a difference between the close of this candle and the open of this candle. This would be a volume imbalance. In this case, it would be a volume imbalance because price actually fills in the void with this wick here. But if we assume this candle wick was not here, we call this a price gap. Don't worry too much about the difference, but just to show you, this would be a volume imbalance because price actually fills in the gap with this wick here. If we look at this price range here, we've got this huge gap from this candle to this candle. There is no wick. There is no trading at all here, so we call this a price gap. Whereas if there was a wick here, something like this, then this would be a volume imbalance because price actually fills in the price range with a wick. We use price gaps and volume imbalances the exact same way. It's just a pattern. Don't worry too much about it. But we have a volume imbalance and the price gap. If we think of a bullish volume imbalance, we've got this candle here from this close to this open. There's a gap. The wick filled in the gap on this candle here with that wick, and therefore this would be a volume imbalance. If the wick was not there and there was no wick here, meaning there was no overlapping wicks, this would be a price gap. We use them the exact same ways, it's just a pattern. If we now look at a breaker, a bullish breaker is where a bearish order block will take out both sell sides and buy side liquidity. So if you remember, we've got down candle, up candle, followed by down candles as soon as price trades below these up close candles here. As soon as price trades below this price level here, this becomes a bearish order block. And this bearish order block took out sell sides and buy side delivery. So this swing low and this swing high. This will become a bullish breaker block. If we look at another example, we've got these down close candles, so up close candle, then all of these down close candles. As soon as price trades above this price level here, these become bullish order blocks. And this bullish order block took out buy sides and sell sides, meaning these bullish order blocks took out buy side liquidity, this swing high, and sell side liquidity, this swing low. This will then become a bearish breaker block. So a bullish order block that takes out buy side and sell sides becomes a bearish breaker block. So now we've covered breakers. We're now going to cover mitigation blocks. Now a mitigation block is similar to a breaker, but in this case, price does not take out one side of the liquidity. So if you look at this down close candle here and just take this final down close candle, as soon as price trades above this price range here, this would become a bullish order block. Price did not trade above these consecutive down close candles, and so we can't call this entire price range a bullish order block. And so we can only call that first down close candle a bullish order block. And remember, a bearish breaker would have taken out buy sides, so this swing high here, and sell sides, this swing low here. However, the bearish mitigation block does not take out buy sides, it only takes out sell sides, and so this would be a bearish mitigation block. So a bullish order block that does not take out buy sides, but only takes out sell sides. If we now look at this example here, we've got this up close candle. As soon as price trades below it, becomes a bearish order block. In order for this to become a bullish breaker, price would have to take out firstly sell sides as well as buy sides. Price does not take out sell side liquidity and just takes out buy side liquidity. And so as soon as price takes out that buy side, this bearish order block, which doesn't take out sell side, only buy side, becomes a bullish mitigation block. And as we can see, price trades into it and then expands away. If we do another example, we can see we've got this price range here, this bearish order block, this up close candle, once traded below, becomes a bearish order block. Price does not take out a swing low, sell side liquidity, but it does take out buy side liquidity, and so this price range here will become a bullish mitigation block. And so we've covered swing highs or swing lows, rejection blocks, order blocks, fair value gaps, liquidity voids, volume imbalances, breaker blocks, and mitigation blocks. The final PDO I'm going to cover is a balanced price range. Now, it's very important that you understand a balanced price range means we have a range of price that has an equal amount of buy side and sell side delivery. Now, there's two ways that we can identify a balanced price range. The first way is we have an equal move higher followed by a move lower. So if I measure in points, how many points of buy side delivery we have from this low to this high, we have 419.25 points of buy side delivery from this low to this high. From this high to this low, all the way back down to this low, we have 419.25 points of sell side delivery, meaning this price range is balanced, and therefore we call it a balanced price range. If price returns to that price range we anticipate it being utilized as resistance. Why? Because IPTA has delivered price efficiently, an equal amount of buy side and sell side delivery. Therefore, a balanced price range is a PD array that we can utilize to measure order flow, because if we have a balanced price range and IPTA returns to it, we can anticipate it being utilized as support or resistance. Similar here, where we can see from this low to this high, 165.75 points of buy side delivery, and from this high down to this low, 165.75 points of sell side delivery, meaning this range is balanced, and we can therefore call it a balanced price range, and we can extend it to the right, and we anticipate that range being utilized as resistance. Why? Well, because if price returns to it, IPTA has already balanced this price range, and so there's no reason for IPTA to go above the price range, and so we can anticipate it being utilized as resistance. And so that's the first way of identifying a balanced price range: equal amount of buy side and sell side delivery. Another example here, balanced price range, price goes higher and then lower. As soon as price goes below, we can anticipate, if we're in a sell program, the price will return to it and utilize it as resistance. The second way we can identify balanced price ranges is by having overlapping fair value gaps. So if we have a bullish fair value gap overlapped with a bearish fair value gap, that would be a balanced price range. Why? Well, because there's an equal amount of buy side and sell side delivery. So if we just look, we have this bearish fair value gap here, which is then displaced above. If we measure the range from this level to this low, and then from this low back up, we can see 73.75 points of sell side delivery, 73.75 points of buy side delivery. This is a balanced price range, and if price returns to that imbalance, we can anticipate it being utilized as support on price. This would be a bullish balanced price range. If we look here, we have this bullish fair value gap, which is overlapped with this bearish fair value gap, this displacement. Again, let's measure the range. 54.5 points of buy side delivery, 54.5 points of sell side delivery, meaning this is a balanced price range, and if price returns to the imbalance, we can anticipate it being utilized as resistance. Another example here, we've got this bearish fair value gap, extend it to the right, which is displaced above, price returns to the imbalance. Why? Because it's a balanced price range, and therefore we anticipate it to be utilized as support. Final example, we have this bullish fair value gap here, which is displaced below with a bearish fair value gap or displacement leg. Price returns to it, utilize it as resistance. Why? Because this entire range is a balanced price range. Now, one thing I want to note about PD arrays is these PD arrays are patterns, and we utilize these patterns in line with the underlying narrative that we've already identified on the higher time frame. So just because you see a breaker formation or order block formation or rejection block doesn't mean anything. It's just a pattern. But if we see a discount array align with our narrative that price is going to go higher and price returns to that discount array, then we can anticipate it being utilized as support. Now, I haven't covered PD arrays in great detail because there's a lot of content out there that covers PD arrays, but I've covered all of the PD arrays that we're going to utilize so that you have a foundation going into the remainder of the protocol. And so that brings us to the end of today's lecture on PD arrays. In the next lecture, we're going to discuss order flow and how to identify whether the higher time frame institutional order flow is obvious, being either bullish or bearish. And so I hope you found some value from this lecture. And with that, I'll see you in the next video. Be safe.